Marc from ADM Investor Services International. With some charts this week, which are all related to the US, but it's really using the US as an example for what's going on in the global economy, and to highlight how the equity market and interest rate markets are actually telling us very different stories. So my first chart today is the S&P 500 index. As one can see, it's almost back to the highs that we were seeing pre the COVID pandemic sell-off that we saw in February and March. It is very much V-shaped, though the V is a slightly peculiar, a cliff edge, and then a more step-like, though not hugely, climb since then. Obviously, it's not necessarily 100% reflective of where the economy is right now, but where the economy is expected to be. But it's painting a pretty optimistic picture that we should be back in a fairly short period we were seeing back in February, pre-pandemic. That seems to me fairly unlikely, to be quite honest, and certainly the message that we're getting from economic data. So it also, one would have to add, this comes despite the fact that the Q2 earnings as of the end of July were basically centering in on a 35.7% fall in S&P 500 earnings for the quarter, which would be the worst results since Q4 2008, where it was considered a news story, those earnings, basically, regardless of whether they're beating estimates or not. The next chart is the VIX Volatility Index. And this is really just to exemplify a very short point that basically the VIX Volatility Index is almost back in the sort of range that it was prior to the crisis, and is basically telling us that investors are not concerned that they should be basically starting to move their portfolios around more defensively. Otherwise, there would be a great deal more volatility. What about the bond market message? Well, the bond market message is a very, very different one. We actually have the US 10-year yield basically closing in on new lows at just 52 basis points. That basically says that interest rates aren't going to be rising anytime soon, that inflation is not going to be a problem, and that growth is going to be very, very weak. Let's add to that what's going on in terms of the shape of the yield curve. The shape of the yield curve is important in terms of inflation expectations. And it's also important in terms of actual government bond supply. This week, the Treasury announced that it's going to be increasing the volumes of its long-dated issuance by something in the region of $20 to $25 billion a month. So there's no shortage of supply, and yet there's no concession in here for that extra supply as we go forward. In fact, we seem to be saying, actually, inflation is going to be dead as a doornail for a very, very, very long time, given that spread is contracting. So we come to my final chart for the day, which is the US dollar index, which is, I think, rather more reflective of, is the US economy going to get more fiscal support and outperform others? We've obviously had a complete loss of faith in Congress at the moment, hence the big sharp fall that we've seen in the US dollar index. I would expect it to recover somewhat, given that the prospects for the global economy. The US is probably in no better or worse a position than Europe, perhaps slightly better, simply because it is less dependent on exports. But this is also not giving us a lot of confidence that without fiscal support, the US economy is going to be doing okay. So the lesson from all of this is very simply, I think there's got to be a meeting of minds between bonds and equities over the next 3 to 4 months.